Hello and welcome to another episode of Darwin Investors. So I get lots of video ideas, but I only have time to make very few videos. So thanks to everyone for consistently tuning in to my sporadic upload schedule. I do appreciate that. Now, when I do record, I do try to provide some sort of value and give like a unique and different kind of perspective on how to generate returns on this kind of wonky market outside of just like buying some stock and hoping and praying it goes to the moon. Now, lately, I've noticed that CNBC is starting to fall in line with a lot of the principles that I've been talking about on this channel, but they don't really provide any context or any tutorials on what they're advocating. So in this video, what I'm going to do is I'm going to go over a couple of videos that I got from CNBC in the past week and try to provide some kind of context. One video talks about investing in low earnings multiple stocks that pay nice dividends, and then on those stocks writing cover calls against the underlying. And then the other video talks about investing in some high dividend ETFs. Now, after the videos, I'll very briefly review covered calls, what they are and how to write them. And then we'll go into depth on each of the high dividend ETFs that were suggested in the second video. I'm also going to tell you about one company that I'm investing in right now that I think satisfies a lot of the principles outlined in the first video. And we'll discuss the possibility of a Santa Claus rally and what Morgan Stanley and Goldman Sachs have forecast for 2023. And at the very end of this video, I'll definitely be sharing a word from my sponsor. So let's get into this with Kevin Simpson of Capital Wealth Planning as he outlines his hard landing playbook for 2023.
Well, I think it depends on what side of the ledger you're on. If you're the stock market, you haven't given up hope. The PPI number, the CPI number, the fact that we might have a 75 basis point break and only get 50 basis point hikes in December have been cause for celebration, and markets have done really well. The bond market, on the other hand, continues to flash red, and it's been inverted for so long on the 210 yield curve that I think we've forgotten about it and become somewhat numb, Scott. But I don't think we can, because here in the US, the bond market is twice the size of the equity markets. They're telling us in no uncertain terms that the Fed's going to push things too far, that they're going to push us into a recession, and we're going to have economic contraction. So a lot of people say that sometimes the bond market is smarter than the stock market. I don't know if that part's entirely true, but I think from the landscape, we've got to keep the hard landing playbook out and in full force and until we get information to say otherwise.
What does that consist of? When I open it up, what's page one say of that playbook?
Yeah, it's not that scary. You know, whether it's a hard landing, a soft landing, no landing, you own high quality companies with good fundamentals that earn money and pay cash to shareholders. But specifically on page one, it goes down to multiples. Because what you worry about heading into next year is continued multiple compression. You know, higher interest rates compressing on multiples. So if you stick with consumer staples, energy, healthcare, financials, companies that are trading closer or in single digit multiples, then you've got less of that compression fear. You also have companies that can generate earnings. And then, as you and I talk about all the time, we want cash flow, we want cash on cash, and most importantly, we want cash flow to shareholders through dividends. So when we go through bottoming processes or lull periods, we're getting compensated with good dividends. So we've got 12.5% cash. We're going to keep writing covered calls, and we're just going to keep adding to those low multiple names because this too will pass. I mean, the good thing about the recession play is that markets are always forward looking. They're looking past the recession maybe already. And when you look at the inversion of the yield curve, most of the time the stocks do really, really well. The S&P, the broad markets in the 12 months following the inversion do great. I think 2002 was maybe the only recent exception to that. So we're just in a waiting period, but there's always opportunity, Scott.
Now, I like what he had to say in that video. Now, I've seen Kevin Simpson several times before on CNBC, and he's usually more upbeat and more constructive on the stock market in ways that you can generate returns and that sort of thing. But you can see that, like right now, he's kind of down on the market. He's thinking that we've got a recession ahead, a hard landing, and he's going to try and protect the people that are investing with him from huge losses. Now, I'm kind of in that same camp. I do see that we're going to have some really hard times ahead, and I'll illustrate why I believe that in just a few seconds here on this here video. But what he's saying is go ahead and buy companies that trade at low price to earnings multiple so you can be better insulated from the multiple contraction that he believes is coming in 2023. You'd like those companies to return money to shareholders in the form of dividends. And ideally, you want the dividends to be similar to short duration bond yields. Now, I am also expecting a pretty high level of unemployment in 2023. I have a friend in the construction industry over in Las Vegas who doesn't know where his next job is going to come from. His current contract ends in January. Now, a lot of the contracts for the builders that are out there building homes right now, that they came 6 months ago, a year ago, but we don't know where the next contract is going to come from because right now the construction industry is pretty much frozen solid. And that's going to affect more than just the home builders. It'll affect the people that sell houses, the mortgage lenders, the companies that refinance houses, the law firms that write the contracts, the companies that make the appliances, the companies that make the semiconductors and the parts that make the appliances, the industrial companies that make the heavy equipment to do the construction in the first place, the chemical companies that make the paint, and so on and so forth. It's just going to have this like knock-on effect all the way down the economy. Now, with all those people out of work, who's going to be paying all their healthcare premiums? Because a lot of these healthcare premiums are subsidized by their employer. Who's going to go out and buy a bunch of oil? You're not really going to need to travel as much. Where are you going to go? It doesn't take very much money to get to your mailbox. Now, I may not even be as constructive as he is on this market. I can see where you can't actually be dependent on investing just in sectors like energy or financials and industrials or healthcare. Unless the Fed reverses course, I can see a scenario where we're only going to have problems like the problems we're going to have. We're going to wish we were just paying 15 extra cents for a dozen eggs. We're going to wish that was the problem. All that being said, the stock market is not the economy. It's going to look past the current situation. It's going to bottom long before the economy bottoms. They're going to actually try and predict when we believe the Fed is actually going to have to reverse course. They don't want to slam this economy into this nasty recession. They're talking about, oh, we can do a soft landing. It just isn't realistic. They're going to hammer this economy. The politicians aren't going to like it. They're not going to sit back and wait for that to happen. So the Fed is going to have to reverse course and get the construction industry moving again. Now, many analysts believe that's going to happen sometime in the first half of 2023. Kevin Simpson also talked about writing covered calls. Now let's have a quick review of covered calls before we get into the next video, which introduces some investment ideas. So here's my trading portfolio for the past month. You can see this is from November 1st through November 26th. Over the month, I've had realized gains of $874.90. I've did that selling cash secured puts and selling covered calls, or as like Mr. Simpson said, writing calls. Now, for selling covered calls, I prefer to own the equities. You don't have to, but I prefer to own it because it's far less risky. You can see I don't make a ton of money doing this, but I also don't lose a ton of money when I lose. It's just my way of providing myself some risk management. Not to say that I haven't made a lot of money doing some pretty risky things. I'm just saying that by and large, I don't. I take smaller risks and then I make less money. Now, to write covered calls, you don't actually need to own the underlying. I just advocate that you should, because if you get assigned, you're going to have to buy the underlying, and then you're going to have to resell it at that higher price no matter what it is. So you stand to lose an awful lot of money if you're selling covered calls without owning the underlying shares. Owning the underlying shares means at least 100 shares. Each contract is 100 shares. So that makes one downside of this is it's pretty expensive to be able to do this. You can sell covered calls without owning the shares. That would require a level 3 options access or options privileges to be able to do so. Again, I don't recommend it, but to better illustrate what a covered call is, let's go ahead and quickly go over here to the trading platform and we'll discuss what a covered call is. I'm going to illustrate this point in the simplest terms, and I know that we can roll calls, and I know that I can go the wheel and sell puts and all that sort of thing. But for the viewer that just is unfamiliar with writing covered calls and then trying to generate a little bit of extra equity with your underlying shares, this is going to be the simplest tutorial that I can come up with. So you're just going to pick an equity that you own and say it's Lowe's. Instead of buying a stock or an ETF, you're gonna choose call, and this is in the Charles Schwab platform. Lowe's is currently selling for $210.97 a share. What I'm saying is, in this covered call scenario, is that if by the 2nd of December, Lowe's finishes below $217.50, someone is willing to pay me 92 cents a share or $92 for the contract, because each contract is 100 shares. So if Lowe's by the 2nd of December is sitting at $215, I get to keep all my shares of Lowe's, plus your $92. And this is how you generate a little bit of extra income with your underlying equities. Should Lowe's finish at 220 for the week, well, then I'll still get to keep the $92, but I'm on the hook to sell all of my Lowe's for $217.50 a piece, even if it's sitting at 220, because I'm a seller of this contract and someone else is a buyer of this contract. So where there's a seller, there's a buyer. And so the risk that I have by doing this is that I will get $217.50 a share for Lowe's. Well, it's currently sitting at $211. So this, a lot of people would say, okay, well, that's not a bad deal. And that's why selling covered calls is considered a really nice way to generate some quick returns. Now, there are ways to roll this covered call. There are ways that once you're assigned to go the wheel and start selling puts on this covered call, but we're just going to go ahead and leave it right at that. That is what a covered call is, and that's what writing a call is. Now let's go ahead and watch a video by CNBC. There's a couple of analysts come on there and they're advocating for investing in some of these high yield dividend ETFs. And then when it's done, we'll go into each of these ETFs and we'll be able to pull it apart, and I'll be able to show you why they're able to give you such a generous return on your investment. So let's go ahead and watch this video.
Welcome to the ETF Edge portion of the Halftime Report. I'm Seema Modi. The market is grappling with a constant push-pull of catalysts in favor of both the bulls and bears lately. Despite data pointing to cooling inflation, the Federal Reserve seems determined to stay the course and carry out its rate hiking agenda. But both with bond yields rising, then falling at a rapid clip, investors may have to look elsewhere for reliable income. One possible solution is looking at large cap companies that not only pay dividends, but grow them consistently. Joining us now is Todd Rosenbluth, Head of Research at VettaFi, along with Brian Geary, Senior Vice President at Amplify ETFs. He runs the firm's Enhanced Dividend Income ETF, that is ticker DIVO, which has attracted some of the largest inflows we've seen all year, ranking in the top 5% of all ETFs in terms of inflows in 2022. So Brian, I'll start with you. Dividend growth ETFs, they've had big inflows this year, but not all are created equal. What sets DIVO apart from the rest?
Yeah, Devo, thanks, Seema. It's a core equity income ETF. So it holds a core portfolio of stocks, large cap, blue chip, dividend paying stocks with a history of dividend and earnings increases. But along with that, there's a tactical covered call approach on the portfolio that actually looks at writing covered calls to provide more income, mitigate some volatility on individual stocks. So it's actively managed by our sub-advisor partner, Capital Wealth Planning, CWP. And we think it provides nice stability, again, a core equity income solution, paying right around the 5%, just shy of 5% current distribution. So good current income, but also good total return potential as well.
Got it. Todd, dividend growers tend to be a good bet in a rising rate environment. What names stand out to you?
Yeah, we at VettaFi, we're hearing from advisors that are looking for an alternative to fixed income to get that stability you talked about, the income generation. So we've seen strong demand for the Schwab U.S. Dividend Equity ETF. SCHD has been very popular on our VettaFi platform and flows in general. We've seen strong interest in the JP Morgan Equity Premium Income, JEPI, which, like that Devo ETF, owns individual stocks and then uses covered calls to be able to enhance that income. There's a wide range of ETFs. You just have to do a little homework to understand what's inside them.
So you could tell from that video right there that based on the high inflows that each of these ETFs seem to be receiving at the moment, that a lot of smart investors are kind of hiding out in these high dividend ETFs while they wait out this market downturn. So let's go ahead and take a peek at what's actually in some of these portfolios, starting with DIVO, because I think that's a really good one. So DIVO, this is the Amplify CWP Enhanced Dividend Income ETF, and it's a derivative ETF. It's a covered call ETF, like he said. You can see that it's rated very highly by pretty much all raters that are right here, as 5 stars on all of them. It pays a 4.86% distribution yield. He said somewhere close to 5, so I'd say 4.86 is pretty close. It pays out a dividend monthly. You can see it's very consistent. Every month it's going to give you roughly 14 cents a share, sometimes more, sometimes less. So it's 14 cents a share. If we had $50,000 worth of this Amplify ETF, what would happen is we would say $50,000, divide it by $36.85, and that would give you 1,356 shares. You multiply that by 14 cents a share, then your monthly return on this is going to be $189.96. But in addition to giving you this money, this ETF doesn't actually go down in value. We could see that over the past 1 year that it's gone up. Well, it's basically flat, but it has paid you close to 5%. And I think any of us would have taken a 5% improvement on our portfolios over the past year, opposed to what we've been suffering through. Over the last 3 years, it's up 17.86%, and over the past 5 years, it's up 28.26%. This is an actively managed ETF. The holdings in it are very conservative. These are the type of consumer staples or defensive stocks that a lot of us wouldn't normally go ahead and invest in, but we'll just kind of hold our nose, buy Devo, and let them actively manage this portfolio with the investments that we wouldn't ordinarily make to protect us from this nasty market. So some of their holdings, it looks like the top holding is going to be Chevron, then United Health, then McDonald's, Home Depot, Microsoft, Merck, UPS, Visa, Johnson & Johnson, Procter & Gamble. You can see that these are all companies that generate a nice dividend, with the exception of probably Microsoft. I think theirs is somewhere less than 1%. Also, of the holdings they have, they do hold 1 to 3 month treasury bills in this ETF. The 1 to 3 month treasury bill is currently paying a yield of 4.26%. The 6 month is trading 4.67%, 12 month is 4.72, and 2 years 4.45. Now remember, this is an annual rate. It's not going to give you 4.26% of your money over 3 months. If you held it for a year, it would give you 4.26%. In addition to that, they're also trading covered calls. And it looks like they have deposits with broker for short positions. That's what they're calling this. So they're trading covered calls on certain equities, and they're hold on to a lot of equities that actually pay a nice dividend. And I'm guessing with a lot of this money, they're trading covered calls on these underlying assets. So let's have a look at the next one. The next one is JEPI. JEPI is also a covered call ETF. It trades for $56.52 a share. Every month it'll give you, let's call it 50 cents a month, maybe a little bit more. Let's go 52 cents a month. And so if you had $50,000 worth of JEPI and you divide that by $56.52 a share, that would give you 884 shares of JEPI. You multiply that by 52 cents a share, and every month JEPI would be paying you roughly $460. The last one paid you about $189. But remember, the last one was up like 20% over the course of X number of years, like 5 years. JEPI is down 8% this year. It does give you a 10.6% distribution yield at the moment. So you would be in total up 2% for the year. The last one would have had you up roughly 5% for the year, because remember, it had a 0% year-on-year return. So this one would be, you would be up 2%. The other one, you'd be up 5%. Over the course of the JPI's history here, you can see it's up 12.83%. So if you're getting up 12.83% and you're getting roughly 11% a year, you're roughly up 30%, I guess, over 5 years. And that's about the same as Devo. They're both about the same. One would have a better return every month. Like, let's say that you're in retirement and this is the what you're going to live off of. I would probably go through one that would actually pay me a monthly yield that was a little bit higher. But if you're not planning on living off this money, you're just reinvesting in the market, I'm not sure it matters which one of these two that you would go with. You can see that they're both very similar. JEPI is also actively managed by JP Morgan. Their biggest holdings are going to be Exxon, AbbVie, Bristol Myers, Progressive, United Health, Hershey's, Honeywell, Coca-Cola, Pepsi, and Travelers Insurance. In addition to that, they also sell covered calls against the S&P 500. And they're listed here. And it looks like currently they have 10 covered calls open against the S&P, meaning that if the stock market goes down, this portfolio makes money. Now, one of the ways that these ETFs are able to give you such a nice return is because we've been going through some very high volatility here recently. I mean, where 20 is actually low, but it used to be 20 was high, okay? But now 20 is low. What does the VIX mean? So the VIX is just basically a measure of volatility, a day-to-day volatility, but measured over a month. So if you're saying that the VIX has a volatility of, say, 16, it would imply a 1% daily move in the S&P 500. A VIX of 32 would say a 2% daily move. Right now we're sitting at 20, so we're saying that we're still implying an over 1% daily move in the S&P 500. Because the daily move is high, it means that there's a lot of volatility, and a lot of these covered call premiums are going to generate a better return. That's why it's good right now to be in some of these. Now, when in times when volatility is low, these are not going to be nearly as good at returning investments as they are right now at this moment. That's what makes these pretty nice right now. Now, another one that was mentioned was this SCHD. Now, this one's not actually a covered call ETF at all. Now, this one is selling for $78.44 a share. It's generating a 3.36 quarterly dividend yield. So it's only paying you every 3 months, and it's about 48 cents. And so if we say, well, what kind of return are we going to get on our dividends with this one? We're going to say, all right, let's say on $50,000, you divide that by 78.44, and that's going to give you 637 shares, and you multiply that by 48 cents. And every 3 months, you'll get $305. So you get about $100 a month. Now, what makes this one cool? So this one, you can see over the past year, even though the market has been down, this one's actually up 1.15%. Plus, you're also getting this 3.36%, which makes it roughly equivalent to DIVO and a little bit better than JEPI from a percent return over the course of a year. JEPI was only returning about 2 to 3%, and this one's returning for about 4%, and DIVO was close to 5%. Over 3 years, SCHD is up 36.8%, and over 5 years, it's up 54.96%. So we can see that we get roughly a 10% increase per year on our underlying shares just on equity return, and we also get a 3.36% annual dividend yield. It's rated 5 stars by Morningstar, whether it's a 3-year rating, a 5-year rating, or a 10-year rating, which means it's a fantastic stock. The underlying holdings are going to be, again, very similar to JEPI and to DIVO, but it's done a little bit differently. So what they're doing is they do go out and get a bunch of defensive holdings such as Merck, IBM, Amgen, Home Depot, and Cisco and the like. And they break it down into, we're going to have 21% IT, 20% financials, 13% staples, and so on and so forth. I think what's really interesting about this portfolio is look what they think is going to do well here in the short run. It looks like it's going to be information technology, and I would agree with that. I think as we get multiple compression through some of the consumer staples and, say, industrials and energy as well, because with oil prices being lower, I would expect that you're going to get some multiple compression out of your energy stocks because they're not going to be making as much profit now as they were, say, back in June. So you would expect that those equity prices should be going down. And for that, energy only makes up 5% of their portfolio. So this is actually a nice stock to generate some returns over time. Now, a different way to go about this, and this would be like the ultimate type of retirement type of stock, would be this XYLD. XYLD is the same sort of thing. It's a covered call ETF. However, it's way different from the others. And what makes it so different is that it loses money with time. You see, over 1 year, it's lost 19.56%. Over 3 years, it's lost 20%. And over 5 years, it's lost 21%. So the advantage of this stock, and you can see it's only rated 3 stars by Morningstar, while the other ones are rated 5 stars. But the advantage of a stock like this one is you get a higher dividend yield per month. And so it actually gives you roughly we'll call it 43 cents a month per share. And so if you had $50,000 of XYLD and you divide that by $40.15, that would give you 1,245 shares. You multiply that by 43 cents a share, And that means that every single month it'll pay you $535. I think JAPI was, I forgot what it was, something like $400, and DIVO was $190. So this would be exclusively for someone who's in retirement trying to get a fantastic yield. As a matter of fact, I think the best yielding one is going to be this RYLD. What is the yield on this thing? It's $19.46 a share. Its yield is 12% and it's paid out monthly. Again, they have the same problem. They go down year on year, the same as XYLD and QYLD. So these are ones that are fine for retirement, but not going to be very good at all for building your wealth. An equity that I've been really getting into here recently, especially after the collapse, is going to be Advance Auto Parts. Advance Auto Parts to me kind of exemplifies what Kevin Simpson said in that first video about buying a stock that has a low price to earnings multiple that plays a nice dividend to shareholders, and one that's going to be comparable to a short duration bond. Advance Auto Parts sells for $150 a share. It has a price to earnings multiple of 19 with a forward price to earnings multiple of 11.85. So it trades at a significant discount to the S&P with respect to its forward PE. Right now, the forward PE of the S&P is about 17.5, and this one's got 11.85. Its dividend yield is 4%, which is roughly equivalent to a short duration bond. So this would be a company that I would expect that would actually go up in value and pay me 4% while I wait. That's why I'm really pretty high on Advance Auto Parts at this moment. Plus, I also like companies like Advance that deal with the retail consumer as well as the professional consumer as well. Companies like this one, Costco and Lowe's, they're companies that I like because of their diverse and reliable customer base. So let's go ahead and see if we're going to have a Santa Claus rally this year. Well, according to this, the stock market is posed for a Santa Claus rally, but not until after the Fed meets. And so you'll have noticed that right here, if you look at the different averages, let's look at the Dow here over the course of, say, a month. Since November 10th, it's done nothing. It's gone up 1.87%. Since the S&P 500, since November 10th, has gone up 1.79%. And the NASDAQ, since November 10th, has gone up 1.01%. So it's trading really flat. So what investors are doing, we're kind of waiting for the Fed, for the CPI data to come out on December 13th and for the Fed to actually give their official rate hike up, what is expected to be 50 basis points on December 14th. But it says that, yeah, the market is poised for a Santa Claus rally, but not until after the Fed meets. And this Mark Newton of Fundstrat weighs in on when he thinks that the market is actually going to peak in the month of December. And he says, I don't think December is going to be straight up. It's normally pretty choppy. Where the market tends to seasonally peak is the fourth week of the month. I think this year's going to be a little bit different because everything is so heavily driven by the inflation data. So I think the CPI coming out on the 13th and the FOMC meeting that raises the market or raises the interest rates 50 basis points on the 14th. I think that that's going to be our catalyst for the market to go up in December. It's not actually going to be in the fourth week of the month. It's going to be in the second or third week. And so that's when I would expect the market to peak in December. And that's when I'm actually going to shift my portfolio pretty significantly because I think I'm going to be able to pull out the most gains at that time. Now, Newton expects the S&P could see a move to 4120 early in the month. Then it's going to retrace and go downward. And then after the FOMC and everything meets, it's going to go back up to 4120 by the end of the year. So I guess he's thinking that it doesn't do you any good to wait till the end, unless, of course, unless the retracement happens, it goes down. My stuff is pretty choppy until about the 20th, and then we go up. I don't know what the year-end targets are. It depends on the degree the market consolidates. I'm willing to say we probably sell off around the Fed and then go higher into year-end. That seems reasonable to me. It's not the way I'm going to play it. I think it is going to stay pretty flat in the Fed, and then I think it's going to go up, and then I think it's going to come down. That's the way I'm going to play it, but he could be right. Who knows? That's just one of these things. You never know who's right. Well, you'll know who's right eventually, but you don't know right now. Now, Morgan Stanley's Mike Wilson predicts the S&P's bottom and in the first quarter of 2023, and he calls it a terrific buying opportunity. So this is a guy that's traditionally very bearish on the market. I mean, he has been a perma bear for about a year and a half, and now he's saying that we have a terrific buying opportunity coming in the first quarter of 2023. And more importantly, he's the chief investment officer for Morgan Stanley, so he's in charge of a lot of money and can move a lot of stock. So this guy is probably somebody that we should be listening to. He says, I think we're in the final stages, but the final stage can be very challenging, right? Street Signs Asia on Friday. Now it's more of a two-way risk, and I think we're going to be in that two-way risk probably until the year end. The final move of the bear market probably comes next year in the first quarter, when the earnings finally catch up to where we think they're going to be next year. Wilson said the S&P 500 will probably make a new low sometime in the first quarter of next year, adding that the low 3000s is a really good range to think about for the low for this bear market. The index closed at 39.46 on Thursday, down about 17% year to date. And then he says that that new low will be a terrific buying opportunity, because by the time we get to the end of next year, we'll be looking at 2024 when the earnings will actually be accelerating again. So what Mike Wilson is advocating is basically to just put in a bunch of money when the market puts in new lows in the first quarter of 2023. And he's anticipating it'll be somewhere in the very low 3000s. And that's the playbook that I'm actually going to follow, because this guy sure knows what he's talking about. Now, Goldman Sachs also gives their official 2023 outlook. Now, they give 4 different scenarios, does Goldman, and they tell you where it's headed and where they think that you should buy this market. Goldman Sachs is predicting 0 earnings growth in 2023, with stocks ending the year essentially flat. The firm is saying that they are saying $224 a share, and the year will... So Goldman Sachs is predicting 0 earnings growth in 2023, with stocks ending the year essentially flat. They think that the index is going to end next year at 4,000, or just over 1% from Monday's close. Now, again, if Mike Wilson is correct and it goes to the low 3000s and we buy in heavy there, and then it ends the year at 4,000, that's a pretty nice gain from where we started. And that's if Goldman is correct and Mike Wilson are both correct. And both of them manage an awful lot of money, so they're probably going to be right. Now, they say they expect less pain, but also no gain, depending on how you play it. Now, their 3-month target on the S&P is 3,600 points, which is 8.86% lower from Monday's close. So they don't think it's going to go as low as Mike Wilson, but they do think that it's going to go lower. They expect that the Federal Reserve's tightening cycle will end next May, which will cause investors to shift their focus to growth for 2024. Both are in agreement that the market is actually going to grow in 2024. That seems to be consensus. Now, their baseline forecast assumes a soft landing for the U.S. economy. I'm not so optimistic as Goldman Sachs, but we'll see. Under the soft landing scenario, their economists forecast below trend GDP growth will be accompanied by just a 0.5 point increase in the unemployment rate to just 4.1%. And the U.S. economy will avoid a recession in 2023. And this is what Goldman Sachs thinks. There's a consensus view that we're going to have a soft landing, avoid a recession, and the unemployment rate will only jump to 4.1%. I hope they're right. I don't think they are, but I hope they're right. The hard landing recession scenario remains a distinct risk, he said. If that happens, he expects the S&P would reach a trough of 3150. This is where I'm kind of thinking. This is what Mike Wilson is kind of thinking. And so this is the camp that I'm going to be in, is the hard landing, a much higher unemployment rate, and a bottom on the S&P of 3150. The combination of a flat return under our base case and large downside in a recession means investors should remain cautious. That means tilting portfolios toward defensive sectors with low interest rate risk, which is why I kind of prefer it to be actively managed by a professional, such as in the case of that Devo or the JEPI. Goldman recommends investors overweight consumer staples and healthcare, which tend to outperform amid slowing growth and rising real rates. The firm also likes the energy sector, which has historically outperformed in periods of stagflation. And stagflation is what many people think we're going to be going into. That's a period of inflation, but not much GDP growth. Goldman also recommends being overweight in telecommunication services, as well as consumer durables and apparel. Now, while utilities have also typically outperformed, they are trading at record high valuations, and therefore Goldman has a neutral rate on the sector. And honestly, for me, consumer staples, they should have a pretty neutral rate as well. Right now, Hershey's is trading at like 31 times, and Pepsi's trading at about 30 times. And so chocolate chips and potato chips are trading way more than microchips, which we're all using in everything we use. And I would consider it far more of a staple because a lot of these chip companies are trading less than 10 times. So I think staples are quite overvalued as well. And you could throw Costco in the mix too. They're trading at like 35 or 40 times as well. In this investor environment, investors should also own stocks that are leveraged to decelerating inflation. He identified 39 stocks from industry groups that typically outperform when inflation is high. They also have a forward earnings yield for the next 12 months and trailing last 12 months, the free cash flow yield above those in the respective sectors in the aggregate index. And so here are the 10 names that they suggest. And I'm not saying in any way go out and buy these. I'm just saying that Goldman analyst says that these are some good ones to look at. And he's looking at Organon and Company, which I'd never heard of, Citigroup, Verizon, Walgreens, Prudential, Alaska Air, DaVita, Microchip Technology, Lowe's, and Booking Holdings. And that was what was recommended by Goldman. Again, I'm not going to be running off to buy those at all. So there you go. There's my take on covered call strategies and also covered call and derivative ETFs and the type of returns they're going to get. We had a look at the Santa Claus rally and what Morgan Stanley and Goldman Sachs thinks might be on the table for 2023. Yeah, if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye.